When you first start looking at charts, they can feel like a maze of random candles going up and down. But beneath all of that noise, there are certain levels, certain numbers, that the market seems to respect over and over again. One of the most fascinating and most widely used tools to uncover those levels is something called the Fibonacci retracement. Now, don't let the word Fibonacci intimidate you. It comes from a 13th century Italian mathematician, Leonardo Fibonacci, who discovered a sequence of numbers that appear everywhere in nature. Seashells, sunflowers, galaxies, even the proportions of the human body. You'll find the Fibonacci sequence at work. Traders noticed that markets also seem to follow these ratios, and so the Fibonacci retracement tool was born. Here's how it works in practice. Imagine the market has made a big push upward. Price has rallied hard, creating what we call a swing low. That's the point where the move began, and a swing high. That's the peak of the move. Once you've identified those 2 points, you can take your Fibonacci retracement tool and drag it from the swing low up to the swing high. What you'll see is a series of horizontal lines appear on your chart. Each line corresponds to a Fibonacci ratio: 23.6%, 38.2%, 50%, 61.8%, 78.6%, and sometimes beyond. Think of these lines as invisible rungs on a ladder that the market respects. When price starts to pull back after a strong move, it often finds support or resistance at one of these levels. Now, here's the key. Among these levels, the 38.2% retracement, often shortened to the 0.382 level, is one of the most powerful. Traders all over the world have noticed that after a strong rally, price frequently pulls back about 38% before reversing and continuing higher. It's almost like the market takes a breath, retraces part of the move, then gears up for the next leg. Let's take an example. Say a stock rallies from $100 up to $120. That's a $20 move. If we measure a 38.2% pullback, that means the market could dip about $7.64 from the high. So from $120, a retracement to roughly $112.36 would line up with that Fibonacci level. If the stock comes down, touches that zone, and then starts climbing again, traders see that as a strong buy signal. Of course, the market doesn't always reverse at the 38.2% level. Sometimes it digs deeper, maybe to the 50% or the golden ratio itself, the famous 61.8% retracement. That 61.8 number is called the golden mean, and it's one of the most important ratios in all of mathematics. In trading, when a market pulls back around 61.8% of the prior move and then bounces, it's often a textbook continuation setup. But here's the thing. You should never use Fibonacci in isolation. That's where a lot of beginners go wrong. They slap the tool on every chart and buy every time price touches a fib line. The reality is, the market is complex. You want to combine Fibonacci with other confirmation signals, maybe a candlestick pattern, a trend line, or a moving average lining up with that level. When multiple forms of analysis converge at the same spot, that's when the probability of a successful trade goes way up. Think of it like this. Fibonacci gives you a map of potential zones where the market might react. But you still need to read the signs to know if the reaction is actually happening. Let's expand on that a bit. Suppose you see price retracing to the 38.2% level. At the same time, you notice a hammer candlestick forming right at that line, a candle with a long wick, showing buyers stepped in to defend the level. That's a powerful confluence. Or maybe the 50% retracement happens to overlap with a rising trend line that's been holding for weeks. That's another strong confirmation. Professional traders think in terms of probabilities, not certainties. Fibonacci retracements don't guarantee a reversal at any given level. What they do is increase the probability when combined with other market clues. And that's really the heart of trading psychology, learning to work with probabilities, not chasing absolutes. Now, let's talk about mindset for a moment, because Fibonacci retracements are as much about patience as they are about numbers. When the market makes a big move, the temptation is to jump right in, afraid of missing out on the trend. But more often than not, the market will pull back before continuing. Fibonacci retracements train you to wait for that pullback, to let the market come to you, instead of chasing price. This waiting game is tough on your psychology. You'll see price racing ahead, and every part of you wants to hit the buy button. But seasoned traders know that discipline pays. By waiting for retracement levels, you get entries at lower risk points with better reward potential. This is where trading shifts from gambling to a structured game of probabilities. Let me paint a picture. Imagine two traders. The first one sees a stock surge upward and buys immediately at the top of the move. Price then retraces down to the 38.2% level, and this trader is now underwater, stressed, maybe even cutting the trade at a loss. The second trader waits patiently, sets an alert near that fib level, and only takes action once the retracement hits and shows signs of bouncing. This trader enters with calm confidence, risk defined, and the odds stacked in their favor. Same market, two different outcomes, all because of patience and planning. That's why Fibonacci retracements aren't just a tool. They're a training ground for your mindset. They force you to slow down, to plan, and to wait for the high-probability setups instead of letting fear of missing out drive your decisions. Another important point, retracements can also act as resistance in a downtrend. The same way they mark pullbacks in bullish moves, they also mark where bearish retracements might stall. So if a stock drops from $150 to $100, then bounces, the 38.2% or 61.8% retracement of that drop might act as resistance, where sellers step in again. That means Fibonacci is a two-way street, useful in both bullish and bearish environments. Over time, you'll start to see these levels naturally on a chart. They won't just look like abstract numbers anymore. You'll notice, oh, price keeps reacting around that 61.8 level, or every bounce seems to stall near 38.2. It's like pulling back the curtain on the hidden geometry of the market. But remember, it's not magic. Fibonacci works because enough traders around the world pay attention to it, and their collective behavior makes those levels self-fulfilling. When thousands of traders are setting buy orders near a Fibonacci retracement, it creates real demand. That's what gives these levels power. So, to recap in a calm and simple way, start with a swing high and swing low. Apply the Fibonacci retracement tool. Watch the key levels, 38.2%, 50%, and 61.8%. Wait for price to pull back into those zones. Look for confirmation, candlesticks, trend lines, moving averages. Trade with patience, not emotion. And here's one final thought before we move on. The beauty of Fibonacci is that it teaches you that the market moves in waves. Price doesn't travel in a straight line. It surges forward, then pulls back, then surges again. By respecting these natural waves, you align yourself with the rhythm of the market instead of fighting against it. One of the most exciting moments in trading is when a market that's been sitting quietly, moving sideways, suddenly makes a big move in one direction. This is what we call a breakout. And while it might look explosive and unpredictable to a beginner, breakouts actually follow certain patterns that traders can learn to recognize and even anticipate. Think about it this way. The market is a lot like a coiled spring. When price is moving sideways for a while, consolidating in a tight range, it's as if that spring is being pressed down further and further. Energy is building up beneath the surface. Eventually, that energy has to release, and when it does, the spring bursts out with force. That sudden release of energy is what traders see on their charts as a breakout. Breakouts usually happen after a consolidation phase. Consolidation is just a fancy word for when the market isn't trending strongly in either direction. Instead, price moves back and forth between a ceiling and a floor, creating a box-like range. Traders who understand consolidation know that it's not just nothing happening. It's actually the market gathering energy, setting the stage for the next big move. Here's the psychology behind it. When price is stuck in a range, buyers and sellers are in balance. Neither side has enough strength to push the market decisively one way or the other. As this tug-of-war continues, tension builds. Orders start stacking up just above the resistance line and just below the support line. Breakouts happen when one side finally overpowers the other, and price shoots through that level with conviction. Let's take a simple example. Imagine a stock has been bouncing between $50 and $55 for several days. Every time it touches $55, sellers step in and push it back down. Every time it dips to $50, buyers step in and push it back up. This creates a tight consolidation box. Now, suppose the stock finally breaks above $55 with a surge in volume. That's a breakout to the upside. Traders see that as a signal the buyers have taken control, and the stock may be ready to trend higher. On the flip side, if the stock breaks below $50 with strong volume, that's a downside breakout, signaling that sellers have gained control. But not all breakouts are created equal. Some breakouts are strong and reliable. Others are what traders call false breakouts, where price temporarily breaks the level but then snaps back into the range, trapping anyone who jumped in too quickly. This is why breakout trading isn't just about spotting the move. It's about understanding context and looking for confirmation. Now, let's talk about the specific patterns traders look for to identify potential breakouts before they happen. The first is the triangle pattern. Triangles form when the market's highs and lows start converging, like two lines squeezing together. Picture a stock making lower highs, but still holding the same lows. That forms a descending triangle. Or a stock making higher lows, but still hitting the same ceiling. That's an ascending triangle. As price gets squeezed tighter, pressure builds, and eventually, it bursts out. The direction of the breakout often follows the slope of the triangle, but you want to confirm it with volume and momentum before committing. Next, we have the wedge pattern. Wedges look similar to triangles, but with a steeper slope. A falling wedge, for example, is when price makes lower lows and lower highs, but the pace of those lower lows is slowing down. That pattern often signals an upcoming breakout to the upside. A rising wedge, on the other hand, often signals a breakout to the downside. The key with wedges is recognizing that the market is running out of steam in its current direction, setting up for a reversal breakout. Then there's the rectangle pattern. This is the simplest of them all, just a horizontal range where price keeps bouncing between support and resistance. Eventually, price will break out of that rectangle, either above the top or below the bottom. The rectangle pattern is a great reminder that markets spend a lot of their time in ranges, and if you can learn to spot those ranges, you can be ready for the breakout when it finally comes. Now, let's bring in some real-world psychology. Why do breakouts work? It comes down to human behavior. Imagine all the traders watching that $55 resistance level in our earlier example. Some of them are waiting to buy if price breaks above it. Others are short sellers who have their stop-loss orders sitting just above $55. When price finally breaks through, both groups act at the same time. Buyers rush in to go long, and short sellers are forced to buy back their positions to cover their losses. This creates a surge of demand that fuels the breakout even further. That's why volume is such a critical confirmation tool in breakout trading. A breakout on low volume is suspicious. It might just be a temporary blip. But a breakout with a big spike in volume shows real participation, real conviction from market players. It's like the difference between someone lightly tapping on a door versus someone kicking it open. One has much more force behind it. But here's where trading psychology really kicks in. Breakouts test your patience and discipline. Many new traders make the mistake of anticipating the breakout too early. They buy right inside the consolidation, expecting it to break any second. But the market loves to test patience. It can stay inside that range longer than you think, slowly grinding down your confidence. And if you keep jumping in early, you'll get chopped up with small losses. The seasoned breakout trader waits. They let the market show its hand. They look for the decisive candle that closes above resistance or below support. They check the volume. They wait for a retest of the breakout level, which often happens as the market tests the new floor or ceiling. Only then do they act. It's not about predicting. It's about reacting with discipline once the breakout is confirmed. Now, let's expand this with a bit of strategy. Say you spot a stock in a rectangle range between $50 and $55. You tell yourself, I'll only buy if it breaks above $55 on strong volume. The stock rallies, pushes through $55 and closes at $56 with volume double the daily average. That's your signal. You enter the trade with a stop loss just below $55, in case it turns out to be a false breakout. Your target might be the height of the rectangle added to the breakout point. So if the rectangle was $5 tall, from $50 to $55, you could target $60 as a reasonable exit. This kind of measured approach keeps you calm, disciplined, and focused on probabilities rather than emotions. You're not just gambling on every move. You're waiting for the right setup and then trading it with a clear plan. Of course, not all breakouts succeed, and that's okay. False breakouts happen all the time. In fact, some traders specialize in trading false breakouts by waiting for the market to trap breakout traders and then fading the move in the opposite direction. For example, if price breaks above $55 but quickly falls back inside the range and closes at $54, that's a failed breakout. Traders who short there can profit as the trapped breakout buyers scramble to exit. So whether you're trading breakouts or false breakouts, the lesson is the same. Let the market tip its hand, then respond with patience and discipline. Breakouts also tie directly into one of the most important lessons in trading psychology. Big moves come after long periods of boredom. The longer the market consolidates, the bigger the breakout move tends to be. That's because more and more traders are watching that range, stacking up their orders, and waiting for the spring to release. So, when you find yourself staring at a chart that feels slow, quiet, and uneventful, don't tune out. That's often when the next big move is just around the corner. To sum it all up in a calm way, breakouts happen when the market finally escapes a consolidation zone. Common patterns include triangles, wedges, and rectangles. Volume is your friend. It confirms whether the breakout is real. Don't anticipate too early. Let the breakout happen, then react. Use stop losses to protect yourself against false breakouts. The longer the consolidation, the more powerful the breakout. You know, most traders think the biggest battle is with the market, but the truth? The biggest battle is with yourself. It's your mind. It's your emotions. It's that voice in your head that says, close it now before it turns into a loss. Or, add more. You're going to double your account today. This is where traders get destroyed. The market is designed to punish greed, to expose impatience, and to magnify fear. And the only traders who consistently win are the ones who learn how to control those emotions. Let me give you an example. Imagine two traders. Both of them know the same strategy. Both of them trade the same stock on the same day. Trader A sees his position go green by $200 and instantly takes profit. He's scared it'll reverse. Trader B lets the setup play out, follows the rules, and exits with $1,500. Now you tell me, was the difference in their technical skills? No, it was psychology. One couldn't control fear. The other trusted the process. That's why I always tell people, trading is 80% psychology, 20% skill. Fear of missing out, FOMO. One of the biggest killers in trading is FOMO. You see a stock ripping up 15%. You see everyone on Twitter shouting about it. Your group chat is buzzing with, I'm in, and your heart starts racing. You don't want to miss out, so you buy at the top. And 5 minutes later, you're the one holding the bag while everyone else is selling into you. Sound familiar? Of course it does. Every trader has been there. The cure for FOMO is discipline. You have to remind yourself, opportunities are infinite, capital is finite. The market will open again tomorrow. There will always be another trade. But your account? You blow it once, and you're done. Greed, the silent account killer. Greed is just as dangerous as fear, maybe even worse. Because greed whispers to you when you're winning. You catch a clean move. Your trade is up $800, and you think, what if I hold a little longer? Maybe it'll double. Then, bam, the reversal wipes out your gains, maybe even turns it into a loss. Greed will always whisper, more, more, more. The key is to set your target before you enter the trade. Know where you'll exit if you're right. Know where you'll exit if you're wrong. And stick to it, no matter what your emotions scream. Patience, the most underrated skill. Most traders lose not because they don't know what to do, but because they can't sit on their hands. They want action every second. They're chasing charts, forcing trades, jumping in without confirmation. Let me tell you something straight. The best traders are hunters, not gamblers. They wait. They stalk. They sit for hours sometimes, waiting for that one clean setup. And when it comes, they strike hard. Think of a lion. Does a lion waste energy chasing every single animal that walks by? No. It waits for the perfect moment, the right prey, the right timing. Then it pounces with precision. That's trading. Overtrading, death by 1,000 cuts. You know the quickest way to blow up your account? Overtrading. Taking 15 trades a day, scalping every little wiggle. You may feel busy. You may feel like you're working, but all you're really doing is paying commissions and bleeding slowly. A few high-quality trades a week can make you more money than 50 random trades a day. Trading isn't about activity, it's about accuracy. Risk management, the shield that saves you. I can't stress this enough. Risk management is the foundation of survival. You can have the best strategy in the world, but if you risk 20% of your account on one trade, you're a ticking time bomb. Here's a golden rule. Never risk more than 1 to 2% of your account on a single trade. That way, even if you hit a losing streak, you'll live to fight another day. Because here's the truth, every trader loses. Every single one. The difference is, pros lose small, amateurs lose big. And when amateurs blow up, they're out of the game forever. The winner's mindset. What separates consistent winners from everyone else is mindset. Winners don't get too high when they win, and they don't get too low when they lose. They treat trading like a business. They show up every day, execute the plan, log their trades, learn from mistakes, and keep going. Trading isn't about the quick rush. It's about building consistency, brick by brick. And I'll tell you something powerful. Your mindset outside of trading affects your mindset inside trading. If you're chaotic in your personal life, if you're impulsive with money, if you can't control your habits, guess what? It will show up in your trading. That's why top traders treat their life like a reflection of their trading desk. Organized, disciplined, structured. Journaling, your secret weapon. Here's one habit that can transform your trading career overnight. Journaling. I know, it sounds boring. But hear me out. Every trade you take, write it down. What was the setup? Why did you enter? Where was your stop? How did you feel during the trade? Did you follow the rules? Did you break them? Do this for 30 days, and I promise you, you'll see patterns. You'll discover that maybe 70% of your losses come from one single mistake you keep repeating. You'll realize you make more money in certain time frames or certain setups. That awareness is how you level up. Professional athletes watch their replays. Why? To find their mistakes and improve. Traders need to do the same. Protecting your energy. Here's something most people don't talk about. Trading drains energy. Making decision after decision, managing emotions, watching screens for hours, it can burn you out. And when you're burnt out, you make sloppy decisions. That's why I always tell traders, don't try to trade the entire market. Pick your niche. Pick your setups. Limit your screen time. Protect your energy so you can stay sharp. Sometimes, the best trade is no trade. Trust the process. At the end of the day, trading isn't about the single trade. It's about the process. If you follow a good process long enough, the results will take care of themselves. You won't win every day. You won't win every week. But over months, over years, you'll build consistency. And that's where the real money is. Let the gamblers chase the quick thrill. You're here to build something lasting. You see, one of the most dangerous traps in trading is something we call the gambler's mindset. It sneaks up on traders, especially after a few lucky wins. You hit a good trade, you double your account in a week, and suddenly you start thinking you've cracked the code. You start believing you can beat the market every single time. But let me tell you something that every professional trader knows. The moment you start thinking like a gambler, the market will take everything back and more. The stock market, the futures market, even crypto, these aren't casinos. The house doesn't have to win because the market isn't the house. The market is just a place where opportunities exist. Your job isn't to gamble. It's to act like a business owner. A real trader sees every trade as just one transaction in a much bigger business plan. Think about this for a second. Let's say you run a restaurant. You buy vegetables, spices, meat, and all the raw materials to cook meals. Some days your customers love the food and you make a profit. Other days maybe it's slow and you just break even, or maybe you even take a loss. But you don't shut down the restaurant after one bad day, right? You keep going because you know the business makes money in the long run if you keep the quality high and the costs under control. Trading works exactly the same way. One losing trade means nothing if you're running your trading like a business. But when you treat trading like gambling, you risk the entire restaurant on a single dish, and that's how traders blow up accounts. Now let me tell you about something even more subtle: emotional attachment to trades. This is the silent killer of trading accounts. Picture this. You analyze a stock, you do your research, you feel really confident. You hit buy, and suddenly you're not just holding a position. You're emotionally attached to it. You want it to win so badly that you stop being objective. You ignore your stop loss. You find yourself searching the internet for articles that confirm your bias. You're no longer a trader, you're a cheerleader. And here's the harsh truth: the market doesn't care about your feelings. The market doesn't care how many hours you studied, how badly you want it, or how much money you've already lost. The market rewards discipline, not emotions. That's why the best traders treat every trade with a cold detachment. They don't marry their trades. They don't fall in love with a stock. They don't care if they're right or wrong. All they care about is whether their trading plan is executed correctly. I'll give you an example. Suppose you're trading Apple. You did the analysis, you think it's going up, so you buy. The next morning, news breaks that iPhone sales are weaker than expected. The stock starts sliding. A gambler or an emotional trader will say, "No, this can't be right. It has to go back up. I'll just hold a little longer." That's how losses spiral. A disciplined trader says, "Okay, my stop loss got hit. No big deal. Next trade." That's the difference between amateurs and professionals. Now, let's shift gears and talk about risk management again. Because if there's one topic I can never emphasize enough, it's this. Traders don't blow up because they're wrong on trades. They blow up because they risk too much on each trade. Let me ask you a question. If you risk 50% of your account on one trade, how many losses does it take to wipe you out? Just two. Two bad trades and you're done. But if you risk only 1% per trade, you could lose 20 trades in a row and still have 80% of your account left to fight another day. Which trader survives longer? This is where the professional mindset comes in. Successful traders don't aim to hit home runs every single time. They're perfectly happy hitting singles and doubles because they know over time, those add up to massive gains. It's about consistency, not glory. I remember reading a study about casino gamblers versus professional traders. The difference wasn't luck, it was math. Gamblers bet their entire bankroll on one spin of the roulette wheel. Professional traders never risked more than a small fraction of their capital. Guess who was still in the game at the end of the month? The traders. And this brings us to another essential point: the power of compounding. Too many traders chase instant riches. They want to double their money overnight. But think about this. If you grow your account by just 1% a day, in less than a year, your money multiplies by more than 37 times. That's the power of small, consistent growth. Trading isn't about getting rich tomorrow. It's about building wealth over time, brick by brick. Let's talk psychology again, because this is where most traders fail. And I want you to be brutally honest with yourself right now. How many times have you broken your own rules? How many times have you said, "Just this once, I'll let the loss run a little longer," or "Just this once, I'll double down on a bad trade"? If you're nodding your head, don't feel bad. We've all been there. But here's the thing. The difference between winners and losers in this game isn't talent, it's self-control. Every time you break your rules, you're basically telling yourself, "I don't respect my own plan." And once you stop respecting your plan, the market will punish you harshly. This is why journaling your trades is such a powerful tool. Most beginners think keeping a trading journal is boring or unnecessary. But let me tell you, it's one of the most important habits you can develop. When you write down every trade, why you entered, where you exited, how you felt during the trade, you start to see patterns in your own behavior. You realize, wow, I keep entering too early, or I always get greedy after 3 wins. Those insights are worth more than any indicator or chart pattern. Because once you understand your own psychology, you can fix it. Another thing I want to hammer into your brain: patience pays in trading. The market doesn't reward the most active trader. It rewards the most disciplined. Sometimes the best trade you can make is no trade at all. There are days when the market is choppy, unpredictable, and messy. On those days, beginners force trades because they feel like they have to do something. Professionals sit back, sip their coffee, and wait. They understand that not trading is also a strategy. Think of it like hunting. If you're in the forest, you don't shoot at every sound you hear. You wait for the right target, the right moment. Trading is the same. You wait for your setup. You wait for your signal. And when it comes, you strike with precision. That's how you win. Now, let me give you a mindset shift that will change how you view losses. Most people hate losing money. It feels painful. But here's the truth: losses are the cost of doing business. Just like a store has to pay rent and buy inventory, a trader has to accept losses. They're not failures, they're expenses. The only time a loss is bad is when you didn't follow your plan. If you stuck to your rules and still lost money, that's fine. That's trading. But if you broke your rules and lost money, that's on you. And the quicker you take responsibility for your own actions, the faster you'll grow as a trader. Let's also address something critical for American traders in particular: the obsession with news and social media hype. We live in a world where Twitter, Reddit, and YouTube can move markets. Meme stocks like GameStop and AMC showed us how powerful online communities can be. But here's the reality: if you're chasing the news, you're already too late. By the time you see a stock trending on Twitter, the big money has already made their move. Professional traders don't chase hype. They anticipate it. They understand that the market is a game of psychology. When the crowd is euphoric, that's when they get cautious. When the crowd is panicking, that's when they look for opportunities. As Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." That's not just a cute quote. That's survival in the markets. And finally, let me say this: trading is not just about charts and numbers. It's about mindset, discipline, and patience. You can have the best strategy in the world, but if you don't have control over your emotions, you'll fail. On the flip side, even an average strategy, combined with rock-solid discipline, can make you wealthy. So, the next time you sit down to trade, don't ask yourself, "Will I win today?" Ask yourself, "Will I follow my plan today?" Because in the long run, that's the only question that matters. When you've been in the markets long enough, you start to realize something most beginners completely ignore: the market is a mirror. It reflects your strengths, but it also brutally exposes your weaknesses. If you are greedy, it will find a way to punish that greed. If you are fearful, it will magnify that fear until you can't take it anymore. And if you lack patience, the market will make sure you pay for it. That's why I always tell traders, it's never really about predicting the market. It's about mastering yourself. Because here's the uncomfortable truth: your worst enemy in trading isn't Wall Street, isn't hedge funds, isn't algorithms. It's the person staring back at you in the mirror. Take greed, for example. Greed whispers in your ear, "Hold on a little longer. Don't book profit yet. What if this stock goes to the moon?" And guess what? 9 times out of 10, right when you listen to greed, the market reverses. Suddenly, the profit you could have locked in is gone, and you're left staring at red numbers, regretting not selling earlier. On the flip side, fear works just as destructively. Imagine you've done your research, you've set your entry, but the moment you're in the trade and the stock dips a little, fear kicks in. You panic, cut your position too early, and then you watch helplessly as the stock rockets exactly where you predicted. You were right about the direction, but wrong about yourself. That's the real pain. Now, patience. Oh, that's the rarest quality of all. Patience is what separates the gamblers from the true traders. Because trading is a waiting game. The best trades often feel boring. You identify a setup, you wait, you do nothing. While everyone else is chasing random moves, you're sitting quietly, waiting for your spot like a hunter in the forest. And when your moment comes, you take it with precision. That's where consistency is built, not from random wins, but from repeatable, disciplined actions. But here's the beauty. These weaknesses, greed, fear, impatience, they're not permanent. They can be managed, they can be trained out of you, if you're willing to put in the mental work. Let me give you a real example. Back when I first started, I had this terrible habit of doubling down when I was wrong. It was pure ego. If a stock went against me, I told myself, no way, I can't be wrong. Let me add more and prove myself right. You already know how this story ends. One small mistake snowballed into a big loss. And it hurt, not just financially, but emotionally. Because I realized I wasn't trading the market, I was fighting my own pride. So I developed a rule. If a trade goes against me beyond my stop loss, I cut it. No doubling down, no revenge trades. Just take the loss and move on. It was hard at first, but over time, it became second nature. And that's what freed me from one of the most dangerous traps in trading. This is what every trader must understand. Trading is not just charts and numbers, it's psychological warfare. You are battling your own impulses every single day. That's why risk management isn't just about protecting your account. It's about protecting your mind. If you blow up your mental state, you can't trade rationally anymore. And speaking of risk, let's talk about the most unglamorous but most crucial part of trading, position sizing. Most beginners think the path to quick riches is putting all their money in one trade. But let me be brutally honest, that's how accounts get destroyed. Professional traders think differently. They don't ask, how much can I make on this trade? They ask, how much can I afford to lose without destroying my capital or my mindset? That's the mindset shift that keeps you alive in this game. Because survival is rule number one. If you stay in the game long enough, opportunities will come. But if you blow up your account chasing one big win, it's game over. I want you to remember this. A single trade should never be able to ruin you. If it can, you're risking too much. Think like a professional. Think like a survivor. And once you master that, when you control your greed, tame your fear, develop patience, and respect risk, you stop being just another gambler in the market. You start becoming a real trader. Because at the end of the day, anyone can win one lucky trade. But the question is, can you win consistently, month after month, year after year? That's the true measure of success in trading. Most people think trading is all about finding that perfect strategy or that magic indicator which will solve all their problems. But let me be brutally honest with you. Your psychology is 10 times more important than any strategy you'll ever learn. In fact, I've seen traders who had average strategies but rock-solid psychology, and they made fortunes. On the flip side, I've seen traders who had the most advanced algorithms, perfect backtests, yet they blew up their accounts because they couldn't control their own minds. Think about it. Markets are not just numbers on a screen. They're a direct reflection of fear and greed, human emotions, playing out in real time. Every candle on that chart is not just price. It's a battle of emotion between buyers and sellers. When you understand that, you realize trading isn't about fighting the market. It's about managing yourself within the market. Let me give you a scenario. Imagine you take a trade, and within a few minutes it goes against you. What do most beginners do? They panic. Their heart rate goes up. They zoom into the 1-minute chart. They start asking themselves, should I close? Should I hold? Should I add more to reduce my loss? This internal chaos has nothing to do with the market. It's your mind playing tricks. And the market loves to punish weak minds. Now, contrast that with a disciplined trader. He already knows where he will exit if he's wrong. He already knows his risk per trade. So, when the trade moves against him, he doesn't flinch. He just executes his stop loss, takes the hit, and moves on. There's no drama. There's no panic. Because for him, it's just numbers. It's a game of probabilities, not emotions. That's the silent edge that most traders never develop. They spend years searching for the perfect entry, when in reality, their downfall is their inability to stick to a plan. Trading is less about prediction and more about consistency. You don't need to predict the market. You need to react to it with discipline. Here's something I want burned into your mind. You are not a trader until you can follow your plan without hesitation. If your emotions override your rules, you're just a gambler with a trading account. Now, Let's break down a few critical psychological traps that destroy traders. The need to be right. Most people hate being wrong. They tie their self-worth to their win rate. But in trading, you'll be wrong a lot. And that's perfectly fine. The best traders in the world are wrong almost half the time. The difference is, they lose small when they're wrong and win big when they're right. If you can't accept being wrong, you'll hold on to losers too long, hoping the market will turn, and that's how accounts get wiped out. Revenge trading. You take a loss. You feel angry. You want your money back right now. So you jump into another trade without thinking. That second trade is usually impulsive and almost always a loser. Then you spiral into more bad trades. This is the fastest way to self-destruct as a trader. Losses are part of the game. Revenge trading is your ego begging for control. Don't listen to it. Overconfidence after wins. Winning feels amazing, but it can also be dangerous. After a big win, many traders feel invincible. They start increasing their lot sizes, taking trades outside of their plan, thinking they can't lose. And what happens? The market humbles them quickly. You must treat every trade with the same discipline, whether you're coming off a loss or a big win. The market doesn't care about your last trade. Fear of missing out, FOMO. You see a candle shoot up, and suddenly your brain screams, "You're missing it. Get in now." That's how most traders get trapped at the worst possible entry. FOMO is nothing but greed disguised as urgency. Remember, the market has been here for over 100 years. It will still be here tomorrow, next week, next year. You don't need to catch every move. You just need to catch the right ones. Now let's talk about developing the right psychological habits. One of the best practices is to detach emotionally from money while trading. Sounds counterintuitive, right? After all, isn't the whole point of trading to make money? Yes, but if you obsess over the money, you'll make emotional decisions. Instead, focus on the process. Focus on making good trades, not making money. When you stick to your plan consistently, the money will follow automatically. Here's another golden rule. Think in probabilities, not certainties. Most people enter a trade thinking, "This will win." That's a mistake. You should think, "This has a 60% chance of winning, and I'll take it because my risk-reward makes sense." When you shift from certainty to probability, losses stop feeling like failures. They become just part of the math. You stop beating yourself up for being wrong and start treating trading like the business it is. And let me be blunt, trading is not about excitement. If your heart races every time you enter a trade, you're doing it wrong. Professional trading is boring. It's systematic. It's repetitive. And that's what makes it profitable. The thrill seekers are gamblers. The disciplined ones are traders. To make this practical, let me give you a small exercise. The next time you trade, keep a notebook beside you. Write down your emotions before, during, and after the trade. Did you feel fear? Did you feel greedy? Did you want to break your rules? Over time, you'll notice patterns in your behavior that hurt your performance. Once you're aware of them, you can start correcting them. Self-awareness is the first step to mastery. The truth is, trading psychology is not something you fix once and forget. It's a constant battle. Even after years in the market, your emotions will still try to interfere. The only difference is, with experience, you'll recognize it faster and shut it down before it costs you money. That's the real progress. So remember this, strategies will change, markets will change, but the core battle in trading will always be with yourself. Master your mind, and the market becomes a lot easier to handle. Now, let me tell you a story that I know will hit home for a lot of traders watching this. A young trader once messaged me saying, "I don't get it. I watch hours of chart analysis. I follow every so-called expert on social media, and still I can't make money. What am I missing?" And I replied to him with something simple, "You're missing you." See, here's the truth. Trading isn't about copying someone else's strategy. You can try to mimic their entries and exits, but you don't have their psychology. You don't have their risk tolerance. You don't have their emotional response when the market dips 5% against their position. That's why blindly following others doesn't work. Instead, you need to build a system that matches your own personality. If you're naturally patient, swing trading might fit you. If you like fast-paced action, scalping or day trading might appeal more. But if you try to force yourself into a style that doesn't suit you, your own psychology will sabotage you every single time. And this is where discipline comes in. You've got to train your brain to treat trading less like gambling and more like running a business. Because here's the thing, gambling thrives on excitement, while trading thrives on repetition and patience. If your trades feel too exciting, you're probably doing it wrong. Now let's talk about something that separates consistently profitable traders from the crowd: journaling every trade. I know, it sounds boring, but here's why it matters. Imagine you're a detective trying to solve a mystery. Every trade you take is a clue. If you don't record those clues, how can you solve the bigger puzzle? When you write down why you entered a trade, where your stop was, where your target was, and how you felt during the trade, you create a mirror. A mirror that reflects your habits, your strengths, and more importantly, your weaknesses. Over time, you'll start seeing patterns. You'll notice, wow, I keep moving my stop too soon. Or, every time I trade the open, I lose. But when I wait an hour, I win. This kind of self-discovery is priceless, and no mentor, no book, no video can hand it to you. You have to earn it by tracking your own journey. Now let's hit a sensitive topic: losses. Too many traders are terrified of losing. They see a red trade, and it feels like failure. But here's what seasoned traders know: losses are simply the cost of doing business. Just like a store owner has to pay rent, electricity, and staff, you as a trader have to pay with occasional losing trades. That's normal. The key is making sure your losses are small. Never risk more than you can handle. I've seen traders risk half their account on one can't-miss trade, and trust me, it missed. That's how accounts blow up. Instead, smart traders accept small, controlled losses and let their winners compound over time. It reminds me of that Warren Buffett quote: "The first rule of investing is don't lose money. The second rule is don't forget rule number one." He didn't mean never take a loss. He meant never let your losses spiral out of control. Now here's the real kicker. Most traders don't fail because of lack of strategy. They fail because of lack of patience. The best setups don't come every minute. Sometimes they don't come every day, and you've got to be okay with waiting. Think about a sniper. A sniper doesn't fire at every bird that flies by. He waits for the perfect shot, and when it comes, he doesn't hesitate. That's what trading should feel like. Patience, followed by precision. Let me give you another nugget here. Simplicity beats complexity. Too many people are obsessed with fancy indicators, complicated chart setups, and endless data feeds. But if you strip away all the noise, the market really boils down to three things: trend, support/resistance, and volume. If you can understand those three, you're ahead of 90% of traders who drown themselves in clutter. So as you move forward, I want you to ask yourself, am I trading with clarity, or am I trading with confusion? Am I building a system that fits me, or am I trying to copy someone else? Because the moment you make trading personal, that's when it transforms. And remember, the market will test you, break you down, and humble you. But if you learn from every scar, every mistake, every sleepless night staring at the charts, you'll come out stronger, sharper, and more consistent. This game isn't about speed, it's about survival. And those who survive, those who stay in the game long enough, eventually thrive. Now, let's dive into something that very few traders actually pay attention to, but it's one of the main reasons why most people fail in trading: the lack of structured trading plans. Most people walk into the markets like they're walking into a casino in Vegas. They sit down, place a trade, and hope it works out. If it does, they get excited and believe they've cracked the code. If it doesn't, they either double down to make it back or walk away frustrated, thinking the market is rigged. But here's the truth. The market isn't rigged against you. It's rigged against undisciplined traders. And discipline comes from having a plan. Think about it this way. Would you fly in a plane if the pilot said, "Well, I'll just figure it out as we go"? Of course not. You want the pilot to have a clear flight plan, prepared for turbulence, fuel stops, landing approach, all of it. Trading is no different. You need a flight plan before you take off. So what does a real trading plan look like? Entry criteria: exactly what conditions must be met before you place a trade. Is it a technical signal? A pattern you've backtested? A fundamental trigger like earnings, or economic data? Be specific. Exit criteria. This is where most traders fall apart. You need to know your stop-loss level before entering. And equally important, your profit-taking strategy. Are you scaling out? Are you trailing a stop? Are you targeting a fixed risk-to-reward ratio? Position sizing. This is where risk management shines. How much of your capital do you put at risk in one trade? If your answer is, as much as I feel like, you're already dead in the water. Smart traders risk between 0.5% to 2% of their account per trade. That way, even if you lose 10 trades in a row, you're still alive to trade another day. Review process. A plan is worthless if you don't learn from your trades. Every single week, sit down and review your winners and losers. Ask yourself, did I follow my rules? Did I break discipline? What patterns do I see in my behavior? Without these 4 pillars, you're gambling, not trading. Now, let me share a harsh truth. Many traders will hear what I just said and nod their heads, but 90% of them will never actually write a trading plan. Why? Because writing one forces you to confront your weaknesses. It forces you to admit when you're acting out of impulse instead of strategy. But here's the beauty. If you're willing to be in the 10% that takes this seriously, your chances of success skyrocket. Let's also talk about market adaptability. The markets are alive. They're constantly shifting, changing, evolving. What worked in 2020 won't necessarily work in 2025. Remember when meme stocks like GameStop and AMC were running wild? Traders who adapted quickly made fortunes. Those who stuck to old-school strategies without adjusting got steamrolled. This doesn't mean you need to chase trends blindly. It means you need to stay flexible, stay curious, and keep learning. For example, algorithmic and AI-driven trading is reshaping the markets right now. Retail traders who understand how these systems influence price action, like how liquidity pockets get hunted, can use that knowledge to their advantage. But adaptability isn't just about tools and strategies. It's about mindset. The trader who says, "This is the only way to trade," is already finished. The trader who says, "Let me learn, let me evolve," is the one who survives for decades. Now, let's hit another important pillar, emotional capital. You've heard of financial capital, but emotional capital is equally valuable. Every time you let frustration, greed, or fear dictate your trades, you're spending emotional capital. And just like money, once it's gone, it's hard to get back. Let's say you had 3 losing trades in a row. That stings. If you keep trading without resetting mentally, you'll probably overtrade, take bad setups, or move your stops just to get one win back. That's emotional capital burnout. Smart traders protect their emotional capital. How? By taking breaks after losses. By lowering risk when confidence is shaky. By detaching their self-worth from their trading results. Your value as a person doesn't depend on whether your last trade was green or red. That's a game changer once you internalize it. Now, let's talk about something American traders deal with a lot: news-driven volatility. The U.S. markets react heavily to news events, Fed rate decisions, CPI reports, job numbers, earnings season, even unexpected geopolitical headlines. If you're trading without awareness of the news calendar, you're playing with fire. I can't tell you how many traders I've seen blown out by holding positions into a Fed meeting without even realizing it. One surprise statement, and boom, the market moves 50 points against them in seconds. Here's what you need to do. Always check the economic calendar before trading. Decide if you're going to trade the news volatility or stay out. Both are fine, but you must decide consciously. If you do trade around news, use smaller positions and wider stops. And most importantly, don't chase after the move once the news hits. The first reaction is usually a trap. Wait for the dust to settle and trade the real trend that emerges after. Let's shift gears to psychological triggers in trading. One of the biggest ones is revenge trading. It's when you take a loss, and instead of accepting it, you double down or force trades just to get back to even. This is a killer. It's like being in a boxing ring, getting knocked down, and then charging blindly at your opponent with your guard down. You're going to get knocked out. Another big trigger is fear of missing out, FOMO. We see this all the time when a stock is spiking. Traders jump in late, thinking, "I don't want to miss this move." But by the time they get in, the big players are already selling to them. And guess who's left holding the bag? The antidote to both of these triggers is patience. Patience is a weapon in trading. If you can wait for your setup and ignore the noise, you'll already be ahead of 80% of traders. Now let's discuss something that separates amateurs from pros: trading journals. If you're not journaling your trades, you're blind. Period. Your trading journal should track entry and exit points, reasons for the trade, emotional state during the trade, whether you followed your plan. Over time, this journal becomes your personal trading Bible. It reveals your strengths, your weaknesses, and your patterns. Maybe you realize you keep losing on Mondays. Or maybe you see you do better trading tech stocks than energy stocks. That's valuable insight, but you'll never see it if you don't journal. Lastly, for today's section, I want to leave you with this. Trading is not about being right. Most new traders believe success means being right 80 to 90% of the time. They think pros almost never lose. Wrong. Pros lose all the time. In fact, many professional traders have win rates of just 40 to 50%. So how are they profitable? Because when they win big. And when they lose small. It's not about being right. It's about managing risk and letting probability work in your favor. Think about a casino. They don't win every hand of blackjack. Sometimes the player wins. But over thousands of hands, the casino's edge plays out. Trading works the same way. Your job isn't to win every trade. It's to manage your risk so that, over time, your edge compounds into consistent profits. Now, if you've been trading for a while, you already know that strategies alone won't make you successful. You can have the perfect Fibonacci setup, every harmonic pattern memorized, and still fail if your mind isn't in the right place. Because trading is a mental game first, a technical game second. And that's what separates casual traders from consistently profitable ones. Let's start with a concept that's rarely discussed, but is critical: mental conditioning. The markets are designed to challenge you emotionally. Every candle, every spike, every gap is testing your patience, your discipline, and your ability to follow your plan. If your mind isn't conditioned to handle these stresses, you'll break. And when you break, the market will exploit it. That's why successful traders train their minds like athletes train their bodies. One powerful technique is visualization. Before you even sit down to trade, imagine yourself going through the trading day. Visualize the scenarios, the winners, the losers, the pullbacks, the breakouts. Imagine yourself staying calm during losses, sticking to your plan, and executing trades with precision. Your brain cannot distinguish between vividly imagined experiences and real experiences. By rehearsing mentally, you prepare yourself to react properly when the real market hits. Another key practice is emotional detachment. Most traders tie their self-esteem to every trade. If a trade loses, they feel like a failure. If a trade wins, they feel like a genius. This emotional roller coaster destroys consistency. You must treat each trade like a business transaction, not a personal test. Detach yourself from the outcome. Focus on process over profits. If your process is sound, profits will follow automatically. Now let's talk about the art of patience at an advanced level. Patience is not just waiting, it's active waiting. It's knowing when not to trade just as much as knowing when to trade. Advanced traders wait for setups that meet all of their criteria. And yes, that often means days, or even weeks, without taking a trade. But when the perfect setup appears, they capitalize with precision. This ties into selective trading. You don't need to trade every move. In fact, trading less often but with higher quality setups is far more profitable than constant activity. Quality beats quantity. Many traders lose because they confuse busyness with productivity. They're constantly in the market, but they're not making money because they're taking suboptimal trades driven by boredom, FOMO, or emotion. Let's now discuss the concept of compounding emotional and financial capital. You already know about compounding financially, winning trades adding to your account over time. But emotional compounding is just as important. Each disciplined decision, each patient trade, each stop-loss respected builds your confidence. Your brain starts learning. I can follow my plan. I can survive losses. I can wait for perfect setups. This cumulative emotional growth gives you an edge that no indicator or chart pattern can replicate. And here's the golden truth. Emotional and financial compounding feed each other. The more control you have over your emotions, the better your decisions. The better your decisions, the more consistent your profits. And as your account grows, your confidence grows, without turning into arrogance. That's the virtuous cycle that separates pros from amateurs. Now, let's address loss recovery and mindset resilience. Every trader faces a drawdown, a period where losses pile up and your account balance shrinks. This is where most traders fail. They panic, they overtrade, they chase, and they blow up. But advanced traders approach drawdowns differently. Step 1. Accept it. A drawdown is not a personal failure. It's part of the game. Step 2. Analyze it. Look at your trades, your plan, your execution. Was the loss due to market conditions, or was it due to your own mistakes? Step 3. Adjust without overreacting. If something needs to change, fine, update your plan. But never throw out your entire system because of temporary setbacks. This leads to mental resilience. Resilient traders don't let a series of losses tilt them. They maintain emotional equilibrium. They know that one day's losses don't define them, just as one day's wins don't make them invincible. Next, let's dive into risk perception and cognitive biases. Humans are wired to react to losses more strongly than gains. This is called loss aversion, and it's why so many traders hold losers too long and cut winners too early. You need to consciously override this instinct. Use fixed rules for stop losses and take profits. Trust your system, not your emotions. Then there's confirmation bias. You see a chart pattern that matches your favorite strategy, and suddenly you ignore signals that suggest it won't work. You convince yourself it's the right trade. This is a trap. Always look at the market objectively. Ask yourself, what evidence contradicts this trade? The answer often saves you from unnecessary losses. Let's also talk about habit stacking for trading success. Trading consistently isn't about a single heroic trade. It's about building systems and habits that produce wins over time. Examples of high-impact habits. Checking your economic calendar at the same time every morning. Journaling every trade, including your emotions. Reviewing charts and patterns daily, even if you're not trading. Setting alarms for major support/resistance levels or market opens. Taking scheduled breaks to prevent emotional burnout. These small, repeated habits compound just like money in a trading account. Over months and years, they create a disciplined framework that gives you an enormous edge over the average trader who relies solely on luck. Finally, let's touch on advanced mindset strategies for high volatility markets. Markets like US tech stocks, crypto, or options can move fast, sometimes too fast for conventional strategies. To succeed here, you need predefined setups. Know exactly when you enter and exit. Don't make decisions on the fly. Adaptive position sizing. Reduce risk on volatile days. Increase slightly when volatility aligns with your plan. Emotional boundaries. Set clear mental limits for daily losses or gains to prevent tilt. Post-trade reflection. Even in fast markets, take a moment to review trades and learn. If you can master these high volatility scenarios, you can take advantage of the best opportunities while avoiding catastrophic mistakes. Now, we've covered a lot in this series, from Fibonacci retracements to harmonic patterns, from breakout and reversal strategies to advanced mindset techniques. But the truth is, all the strategies in the world won't make you profitable if you don't combine them with discipline, psychology, and a structured approach. Let's start with strategy integration. Every trader has a toolbox. You've got Fibonacci retracements, Elliott waves, breakout patterns, candlestick patterns, and momentum indicators. But the magic happens when you combine them intelligently. For instance, imagine you see a potential breakout forming at a key Fibonacci level. You check the candlestick patterns and see a bullish engulfing candle forming. Then you look at the RSI and notice it's coming out of oversold territory. Boom! You've got multiple signals confirming a trade. That's how pros increase their probability of success. Another example, Elliott waves show a possible wave 4 pullback to the 0.382 level. You combine it with a fair value gap and volume spike to confirm your entry. Again, higher probability. The point is, don't rely on just one tool. Layer them. Look for confirmations across multiple time frames and instruments. That's how you create trades with better odds, not just hope. Next, let's talk about risk management, because this is the foundation of survival. We've touched on it before, but here's the real secret. Protecting your capital is more important than chasing profits. Always risk only a small percentage of your account per trade. Use stop losses religiously. Don't move your stops impulsively. Take partial profits when necessary and let the rest run with trailing stops. Remember, one catastrophic trade can wipe out months or years of profits. The best traders are alive tomorrow, not just right today. Survival is everything. Now, let's discuss consistency and routine. Trading isn't a sprint, it's a marathon. The market will test you every day. Some days will feel like a battle, others will feel like a breeze. The key is to stay consistent. Follow your plan every day. Journal every trade without exception. Review your trades weekly, analyze patterns, and adjust slowly. Maintain a healthy lifestyle, sleep, exercise, and diet all affect decision-making. Consistency compounds over time. Small edges repeated day after day build massive results. Another critical component is mental resilience. The market will hurt you. It will tempt you, frustrate you, and sometimes humiliate you. But your mental toughness determines whether you thrive or fail. Advanced traders practice emotional detachment from trades, acceptance of losses as part of the process, avoidance of revenge trading and FOMO-driven decisions, maintaining a positive, growth-oriented mindset. Think of it like training for a sport. You can't become a champion by winning a few games. You have to endure the grind, the losses, and the long hours of practice. Trading is exactly the same. Let's also highlight adaptability. Markets are dynamic. What works in a trending market might fail in a choppy market. News events, macro trends, and technological shifts change market behavior constantly. Learn to read the market structure. Higher highs and higher lows for uptrends, lower highs and lower lows for downtrends. Adjust strategies based on volatility. Use oscillators for sideways markets and momentum indicators for trending markets. Adaptability keeps you alive and profitable even when conditions change. Now, here's a principle that most traders overlook: simplicity over complexity. Many traders fall into the trap of thinking that the more indicators they pile on a chart, the better they'll trade. Wrong. Complexity creates confusion, hesitation, and overtrading. Simplicity allows you to act decisively. Focus on key levels, support, resistance, and fair value gaps. Trend direction, up, down, or sideways. High probability setups confirmed by multiple signals. If you master these simple building blocks, you can navigate any market. Finally, let's talk about long-term vision. Most traders fail because they're too focused on short-term gains. They want instant gratification. But trading is about long-term compounding, both financially and psychologically. Treat every trade as a learning opportunity. Celebrate following your plan more than hitting a profit target. Keep your eyes on the bigger picture, surviving, growing, and improving consistently over years, not days. The truth is, trading is not about winning every trade. It's about creating a system where, over hundreds or thousands of trades, the odds are in your favor and your edge compounds over time. So here's the ultimate takeaway for this video. Build a system that fits you. Strategies alone won't make you successful. Protect your capital. Small losses today allow you to fight another day. Layer confirmations. Use multiple signals to improve probability. Master your mind. Discipline, patience, and emotional control are your real edge. Stay consistent and adaptive. The market evolves, and so should you. Focus on the long term. Profits compound, but so does experience and confidence. If you can internalize these principles and apply them every day, you'll position yourself to not only survive, but thrive in the markets for years to come. Before I close, I want you to do something simple but powerful. Take a deep breath, write down your top 3 trading rules, and commit to following them every day. No excuses. That single act, repeated consistently, will transform your trading journey more than any indicator or chart pattern ever could. Thank you for watching this full video. If you enjoyed it, I'd appreciate it if you like, comment, and subscribe. It helps me create even more high-quality trading content for you. Also, check out my other videos for additional strategies, tips, and market insights. Keep learning, stay disciplined, and I'll see you in the markets.